Hi everyone. Welcome to our financial institution presentation on Goldman Sachs. My name is Katie, and today Erin, Julia, Matt, and I will be discussing the history of Goldman Sachs, their company activities, and their controversies. To begin, I'll start by taking you through an overview of the history of Goldman Sachs. The financial company now known as Goldman Sachs began in 1869 in New York City. It was founded by Marcus Goldman, who was later joined by his son-in-law, Samuel Sachs, in 1882. Goldman Sachs first joined the New York Stock Exchange in 1896. The first company taken public by Goldman Sachs was Sears, Roebuck & Company in 1906. This was soon followed by other successful IPOs from companies like FW, Woolworth, and Continental Can. In 1928, the company launched the Goldman Sachs Trading Corporation. This was to be the largest investment trust established in the United States with an initial stock price of $104 per share. Unfortunately, Goldman Sachs Trading Corp would come to bear the full brunt of the stock market crash of 1929 amidst accusations that Henry Goldman had engaged in share price manipulation and insider trading. By January of 1930, the stock price for Goldman Sachs Trading Corp sat at $40.94. By mid-1932, each share was only valued at $1.75. This forced Goldman Sachs to liquidate their assets and severely damaged their reputation as a strong global financial institution. Sidney Weinberg was then appointed the firm's new leader and would work on rebuilding the company for the next 4 decades. After the catastrophic failure of the Goldman Sachs Trading Corp, Weinberg shifted the company's focus away from trading and instead towards investment banking. Goldman Sachs acted as the lead advisor on the Ford Motor Company's IPO, which was the largest common stock offering to date. This newfound success allowed Goldman Sachs to establish its first international office in London in 1970, beginning the company's push towards globalization. In 1990, the firm was taken over by Robert Rubin and Stephen Friedman, who both directed Goldman Sachs to prioritize the globalization of the firm in order to strengthen the merger and acquisition and trading business lines. It was here that paperless trading was introduced to the New York Stock Exchange, and the first ever global debt offering by an American company was managed. The two directors soon left Goldman Sachs in 1994 as a result of controversy over bailouts made to Mexican banks. John Corzine became CEO of Goldman Sachs after Rubin and Friedman exited the firm. The next 6 years saw many successful IPOs under the guidance of Goldman Sachs, such as Rockefeller Center and Yahoo. After many heated debates among company executives, Goldman Sachs decided to go public in May of 1999. They sold 12.6% of the company to the public at $53 per share. After the successful IPO, Henry Paulson replaced John Corzine and became chairman and chief executive officer of Goldman Sachs. Today, the 21st century has seen further successful growth for Goldman Sachs. The firm started out January 2000 with acting as a lead manager for the first internet bond offering for the World Bank. Goldman Sachs' most recent notable acquisition took place in May 2019 when the firm acquired United Capital Financial Advisors, LLC, for a total of $750 million. Goldman Sachs has since come a long way since the formation of the company in 1896. It now handles a vast assortment of operations such as advising companies, financing government projects, transacting in financial markets, managing assets for institutional and individual clients, investing capital, and even online banking. The company is divided into 3 primary business segments. The first business segment is called investment banking. It primarily serves financial institutions, governments, and corporates. This division accounts for 21% of the company's total revenues. The most common activities undertaken in this division are financial advisory and underwriting. The second segment Goldman Sachs operates in is called securities. This division also mainly serves financial institutions, governments, and corporates. This division accounts for 16% of the company's total revenues. This division involves debt securities, loans, real estate, and public and private equity securities. Goldman Sachs may also invest directly in publicly and privately traded securities through its own investment funds or by using third-party managed funds. The third segment Goldman Sachs operates in is referred to as investment management. This segment is meant to serve individual clients. This division used to account for the highest percentage of revenue within the firm at 45%. Nowadays, investment management brings in closer to 18% of revenue. The services provided by this division changes based on the client and asset class. They include client acquisition activities, interest rate products, credit products, mortgage products, currency products, and commodity products. Goldman Sachs serves a wide variety of recognizable corporations from around the world. One of their most notable investments includes an initial investment in Facebook back in 2011. This spawned a big wave in startup funding from multiple nationally recognized investment banks. Other notable tech investments coming from Goldman Sachs include Spotify, Shift, and Square. Some companies taken public by Goldman Sachs include Sears, Ford Motor Company, and Microsoft. The current CEO and chairman of Goldman Sachs is Lloyd C. Blankfein. He first joined the firm in 1982 and has headed the firm since 2006. He is one of the highest paid executives on Wall Street. The president and co-chief operating officer of Goldman Sachs is David Solomon. He initially joined the firm in 1999 as a partner, but ended up co-heading the investment banking division from 2006 to 2016. In 2016, he was promoted to his current position to fill in for his predecessor, who was appointed chief economic advisor under the Trump administration. The other president and co-chief operating officer of Goldman Sachs is John Waldron. He first joined Goldman Sachs in 2000 and has held many roles in the company. He has been in his current role since 2018. The vice chairman of Goldman Sachs and the chief executive officer of Goldman Sachs International is Richard Nod. He began working for Goldman Sachs in London in 1987. In 2006, he became the co-chief executive officer of Goldman Sachs International next to Michael Sherwood. Sherwood announced his retirement in 2016, and ever since, Nod has been the sole executive in this position. The executive vice president and chief of staff and secretary to the board of Goldman Sachs is John Rogers. Rogers joined Goldman Sachs in 1994 in the fixed income division and eventually became the chief of staff. He was named one of the 11 executives of the firm by CEO Lloyd Blankfein in 2011.
No company is immune to scandals, and Goldman Sachs is definitely no exception. Through the company's lengthy history, they found themselves at the receiving end of a lot of vitriol for their actions. Some of their biggest missteps in recent memory include their contribution to the 2008 housing market crash, a toxic company culture, their contribution to the Greek debt crisis, and contributing to the corrupt 1MDB fund. Starting with the 2008 financial crisis, before the market collapsed, Goldman Sachs unveiled the Abacus 2007 AC1 mortgage security and heavily marketed it to interested customers. However, the company was also shorting mortgage bonds at the time, as they could see that the market was going down. And how could they not see that? They were a part of it. They market their mortgages to people buying houses they couldn't afford. Once payments stopped, they would foreclose on the house and seize assets, only to keep repeating the process. Because processing so many subprime mortgages isn't sustainable, they would bundle them with mortgages that they could collect from and form collateralized debt obligations. Once the bad mortgages were bundled with the good ones, they could hide the shady dealings from investors. After the market crash, the SEC sued Goldman Sachs. In the lawsuit, Goldman Sachs admitted that there wasn't enough information disclosed about the shorting of mortgage bonds nor the predatory nature of the Abacus mortgage. After agreeing to pay over $1 billion in fines, critics were quick to point out the connections Goldman Sachs has within the federal government. Henry M. Paulson, the at-the-time Treasury Secretary, who was recruited by at-the-time Chief of Staff Joshua M. Bolten, were both Goldman Sachs alumni. Paulson filled his Treasury cabinet with other high-ranking Goldman Sachs alumni during the 2008 crisis. They were in charge of distributing the bailouts, of which Goldman Sachs received $10 billion. And all while this is going on, while the market is tanking, they're ordered to pay fines, requesting bailout money to stay in business. Goldman Sachs issued $1 million bonuses to over 900 employees. Contributing to the mayhem of the 2008 crash is an indication of an overly competitive culture, and this was brought to light by Greg Smith, a former Goldman Sachs employee who wrote an article titled "Why I'm Leaving Goldman Sachs" to the New York Times. He cited an overly aggressive sales strategy being pushed on employees. The toxic culture that was brewed from that was not able to be tamed by CEO Lloyd C. Blankfein and President Gary Cohn. He further emphasized that the company put their profit and gains ahead of the customers. Going back to 2001, Goldman Sachs had loaned Greece nearly $3 billion disguised as an off-the-books loan cross-currency swap. This was to help with the worsening European debt crisis at the time. For this, Greece paid them 600 million euros. However, later in the year, the bond yields tanked and greatly increased the interest due because the interest calculations that Goldman Sachs had set was heavily reliant on the bond yield. Goldman Sachs then refused to amend the deal and further plunged Greece into debt because of these high interest payments. And in a very recent scandal that's still developing, Goldman Sachs contributed to the One Malaysia Development Berhad, or 1MDB. The fund was established by the Malaysian government to assist the growing economy and help give it a jumpstart. However, the fund was secretly a funnel that was just putting money into the politicians' pockets. This included Malaysian President Najib Razak, who was sentenced to 12 years in prison. In July of 2020, Goldman Sachs admitted that they paid bribes to officials and ignored the red flags of the fund. They agreed to pay back any and all profit they earned from their donations, as well as additional damages, bringing the total paid for this to nearly $4 billion.
So now let's move on to the COVID-19 impacts. So how has Goldman Sachs responded to COVID? The first thing that Goldman Sachs did was issue a relief bill, which offered over $38 billion in funds, and the employees raised 2,771 donations and supported over 1,440 different nonprofit organizations. The fund was also created to specifically target places that had been most affected by COVID. Goldman Sachs also offered a lot of COVID-19 education on their website. This is really important, especially with so much misinformation throughout the media. So Goldman Sachs having reliable sources and information is a great way to spread what's going on with COVID-19 around the world. Another thing Goldman Sachs offered was delayed loan payments. In June of 2020, over 100,000 customers had opted to postpone their loan payments. Goldman Sachs also partnered with Amazon to, quote-unquote, offer small business owners revolving credit lines with a fixed annual interest rate. Both the delayed loan payments and the partnership with Amazon offered their customers a lot of financial flexibility. And this is something that customers will feel grows their relationship after being showed that Goldman Sachs cares for them. The final thing that Goldman Sachs did about COVID that really stood out was offering their employees free COVID tests. This began back in October of 2020 when employees started coming back to work. At this time, only a few other financial institutions were offering the same for their employees. Okay, now let's move on to the sustainable finance that Goldman Sachs is offering. So what is a green bond and why is it important that Goldman Sachs is offering it? The definition for a green bond is a type of fixed income instrument that is specifically earmarked to raise money for climate and environmental projects. Goldman Sachs has been issuing green bonds, and it is very important because this green bond market issuance should reach about $1 trillion before 2022. Goldman Sachs is able to help the international market by having a lot of these issuances occur in Europe. The European green bond market is one that is surging as well, as it has accounted for 45% of the green bond issuance. Another few things that Goldman Sachs has done for sustainable finance is their creation and establishment of the Environmental Policy Framework in 2005, which established that the growing concerns for our world's climate issues would be addressed and steps would be made to become carbon neutral, reduce waste, and overall join the fight against global warming. Along with that, they have two programs called 10,000 Small Businesses and 10,000 Women, which focus on job creation and economic success. Finally, they have a strong support of lower income communities, and they help these communities through affordable housing, revitalization projects, construction, job creation, and more.
Goldman Sachs' dedication to their client is their top priority. With this, the company has made a commitment to having a diverse set of personnel in efforts to be most helpful to their clients. In addition, as part of the Diversity and Inclusion Initiative, Goldman Sachs has made a commitment to creating and sustaining a diverse work environment. Goldman Sachs has partnered with the Global Diversity Committee to create progress towards becoming a diverse company. This year, Goldman Sachs has created significant strides in the representation of women globally, Black professionals in the UK and the Americas, and Hispanic and Latino professionals in the Americas as well. When focusing on diversity and inclusion, Goldman Sachs is making efforts to advance their company's racial equity. The main purpose of the Goldman Sachs Fund for Racial Equity is to help organizations that are tackling racial injustice, structural inequity, and economic disparity. It started with a $10 million fund, and it has expanded in the past 10 years to more than $200 million. These funds are used directly to create ways to help the communities of color, and they help start important conversations. Focusing on the economic progress, the fund hopes to find nonprofits that will assist Black communities facing economic obstacles. The fund looks for nonprofits involved with efforts to fix racial inconsistencies in the criminal justice system, as well as those that fight racism or that attempt to mend the educational achievement gap. Goldman Sachs has been recognized for their work with diversity and inclusion through a variety of awards. Just a few examples are recently in January 2021, 6 employees made the Involve Outstanding LGBT plus role models list, and also in September 2020, 6 staff members also made the Hurros Women Role Models Advocate list. In addition to racial equity, Goldman Sachs focuses large efforts towards representing women in their staff. Goldman Sachs has created Launch with GS. This is a $500 million investment program that helps women, Black, Latinx, and other diverse clients. In regards to philanthropy, Goldman Sachs created the 10,000 Women program to make opportunities for business education for women around the world. This program was created with the purpose of investing in women entrepreneurs, as this would transform the health of communities and the economy. With access to education, financial support, and a mentorship program, the Goldman Sachs believes that they can fight for gender equity. 10,000 Women involves 10,000 women, 100 countries, 30 top business schools, and 100 partners. After finishing the program, women report instant business success. This program now includes a free online program that allows women the ability to advance in business from anywhere. Goldman Sachs also reaches its diversity efforts outside of its own company. Goldman Sachs put over $300 million into business is owned by women and minorities in New York, for example. Over in London, they invested €100 million into small and average-sized companies as well. This supported over 200,000 labor hours. In Bengaluru, India, diverse vendors supplied 64% of the core and 33% of the interior construction on a campus. Goldman Sachs' vendor diversity program allows them to partner with small businesses globally. They aim to team up with a diverse set of vendors that will challenge them creatively. This program began in 2000 in North America, made its way to Europe in 2005, followed by Asia Pacific in 2009. By partnering with vendors around the globe, Goldman Sachs benefits their staff, is improving their supply chain and their global impact. Goldman Sachs' goal by 2025 is to use 50% more capital on their diverse vendor partners. One of Goldman Sachs' most important programs is their 10,000 Small Business Investment. This program facilitates access to college for entrepreneurs and small businesses, and it offers small business owners a support network where they are able to interact with professionals for advising and financial support. The 10,000 Small Business Program has helped businesses in all U.S. states. It has 9,700 successful graduates and has teamed up with 100 partners. Goldman Sachs has other notable charity involvements as well. Goldman Sachs Gives is committed to fostering innovative ideas, solving economic and social issues, and enabling progress in underserved communities globally. This fund functions as Goldman Sachs' senior staff suggests grants to nonprofits. Goldman Sachs Gives has teamed with 8,000 nonprofits in 100 countries to give over $1.8 billion. Another involvement for Goldman Sachs is Community Teamworks. This started in 1997 as a program where Goldman Sachs personnel volunteered to share their experience and knowledge with nonprofits all over the globe. There were 550 personnel who volunteered 3,500 hours sharing their experience to 1,300 veterans. In addition to these programs, Goldman Sachs makes other huge efforts to support veterans. Some examples include the Veterans Integration Program that assists veterans return to work by expanding their access to mentorship and career services in a 2-month program. Goldman Sachs also co founded the Veterans on Wall Street, a program focused on finding jobs in finance for veterans. Although these are good first steps in the right directions for Goldman Sachs, they have a long way to go in order to reach full representation in all communities. Now we are transitioning into the currency trading portion of our presentation. Starting with our currency trading overview, we went in with a holding strategy due to expected COVID-19 stimulus bills from the United States. We expected that the U.S. government was going to stimulate exports by making the USD cheaper. This did not pan out as we anticipated in the short timeline we had. However, holding strategies normally do better long term, and we think that if we were given more time, we could have achieved a profit. In total, we had 4 trades. We had the euro, the Australian dollar, the British pound, and the Japanese yen. We chose to deal with these first world currencies in order to offer us greater stability. On average, each trade was $10,000. We traded using stop orders as a tactic, with most of our trades closing in just a few days. The only currency we didn't have a stop order on was the Japanese yen, which we held, but we never ended up selling it.
We lost on the majority of our deals, which averaged around a 20 pip loss and a total loss of around 150. Towards the end of our trading period, we were holding on to a large amount of yen as a last-ditch effort for profit. If we had sold it in time, we would have realized a gain of around 10 pips, which totaled around $118, which would have lessened our losses. Moving on to the unrealized gains, more specifically, we had bought this yen as towards the end with about a week left in the trading deadline. We want the yen due to its low relative strength index, which indicates that it's undervalued and should be increasing. We are hoping that it would continue to increase and that we'd be able to sell it right before the trading period ended. Hindsight is always 20/20, and knowing what we know now, we should have sold it on February 16th, which would have made our losses only around $30 instead of the $150 that it was at the end of the period.
We decided to invest in the pound based on its promising moving average overlay. We bought in on January 21st and hit our stop limit on the 22nd. We put a stop limit in for safety, but the limit ended up being much too narrow, and as a result, we bailed too early. We lost $149.80 on this trade. In hindsight, we should have held our position longer to realize the gains seen later in the month. We then chose to invest in the Australian dollar based on their promising COVID-19 pandemic response. We bought in on January 12th and hit our stop limit on January 27th. We put in a stop limit for safety, but the limit again ended up being much too narrow, and as a result, we sold the Australian dollar as soon as it started to go down under. We lost $105.20 on this trade. In hindsight, we should have held our position longer to realize the gains seen later in February. Finally, we decided to invest in the euro based on its promising moving average overlay in early 2021. We bought in on January 21st and hit our stop limit on February 2nd. We put a stop limit in for safety, but again, the limit ended up being much too narrow, and as a result, we bailed too early. We lost $132.50 on this trade. In hindsight, we should have held our position longer to realize the gains seen later in February.
Our group wanted to have low-risk investments, and our trading decisions represent that. We used a moving average overlay to invest when the currency was at the lower side of its average. Along with that, we used a relative strength index, or an RSI, to look at the history of a stock and determine if it was strong or weak. We also used stop limits, which actually came back to bite us, as if we wouldn't have sold stocks early, we could have become much more profitable. Finally, we used current trends and current global events to determine which currencies were more risky than others, and then invested based on that information. Overall, we had a net asset value of $99,707.31, and our total balance was $99,589.15. Our realized loss was $387.50, and our unrealized profit was $118.16. So overall, we had a small loss, but nothing very significant. Our low-risk strategy ended up having us lose a little bit of money, but overall, it was pretty solid considering that we wanted to be safe and we just didn't want to lose a significant amount of money.